Year, and hope everybody had a great holiday season. Once again, this is the GVA 2024 Economic and Market Outlook session here to start off the new calendar year. I hope everybody had a great holiday, and this is a recorded call, so if it's a situation where you have to jump off early or would like to watch a rerun of this session, you can always access that on the GVA internet site. I'd also like to take this opportunity to welcome any advisor clients that are sitting in on this call. This is an opportunity for us. You may see the Great Valley Advisor Group name in some of the materials that you work with your advisor. This is an opportunity for us to basically share some of the information that we provide internally in supporting the advisors that work with you to you as the end client, and have you be a part of some of the sessions that we have throughout the year. So would like to welcome you and also wish you a happy new year as well. So we will get started here. We now have 2023 in the books, and although it's not necessarily necessary to measure investment performance based on calendar years, the reality of it is it's a factor that drives the investor decision-making process, whether it's harvesting losses in a tax-managed investment account, or just in terms of getting a fresh start on a new year. And it's worthwhile to take a look, given the year that we've just had, what can we expect in the year ahead? And in order to do that, I'm going to share a slide deck that may have already seen some of this material in advance of our call. I'm going to share a slide deck that I'll be using for materials that we'll discuss throughout our session here today. So in looking ahead to what we can expect in 2024, it's worthwhile to take a reflection on what we experienced in 2023. Heading into 2023, we were coming out of a difficult year for the economy and for the markets in 2022. We had some consecutive quarters of negative GDP growth that weren't officially declared to be a recession in the first and second quarters of 2022. And we had a bear market, not only in the stock market, but also in the bond market. It was the first year in several decades where we had a decline both in the stock market and the bond markets more than double digits in 2022. So there was a lot of concern as we entered the 2023 calendar year about the fact that we might be heading into an economic recession. And the consensus view was, hey, 2023 is going to be a hard year because the economy is likely to slow. All these Federal Reserve interest rate hikes and all of the challenges that we were confronting heading into 2023 was likely to set up for a tough economic and market environment. And what we had was something that was anything but. It was a strong year for the U.S. economy. And that recession that was so widely anticipated going in 2023 never ended up materializing. Before we have a chart showing the economic growth, GDP, gross domestic product, real on a quarterly basis, basically inflation adjusted to show whether the economy is growing. Bars to the upside shows the growing economy. Bars to the downside show that shrinking economy. So you see those two negative bars there in the first quarter and the second quarter of 2022. For you Econ 101 fans out there, the technical definition of a recession is two negative quarters of GDP, but wasn't really ever declared that by those that take care of that for the federal government. But as we get into 2023, those three bars to the right, because we don't have an official number for 2023 Q4 yet, solid economic growth, north of 2% in the first two quarters of 2023, closing in on near 5% in the third quarter of 2023. And as for the fourth quarter of the year that just ended, likely to see economic growth anywhere in between 1.5% to 2.5%. That's a rock solid year in an environment where many were expecting recession going into the year. So the economy remains strong. It remains resilient. But the question is, what should we reasonably expect as we go into the coming year? Well, one of the most important things to mention, you think about those key elements that drive the economy. Basically, business activity, the labor market, whether people have jobs or not. How does the housing market look? What's the inflation situation like? All of those are key elements that feed into the output that's generated by the economy. How much products and services are we making, and what's the value of those products and services that we're making as an economy in a given year or a given quarter? Well, one of the continued tailwinds for the US economy as we go into 2024 is that the labor market remains tight. And what do we mean by a tight labor market? People who want to have jobs. And companies who want to hire people to have jobs are having trouble finding qualified people in order to fill those jobs. One of the things that we typically see as we enter into and head into recessions is we see a meaningful increase in the unemployment rate. And although we've seen the unemployment rate tick up maybe a little bit as we've gone through the end of last year, we still remain at historically low unemployment rates going all the way back to the 1950s. This is typically not the backdrop here for the looming onset of a major recession. So as long as companies are continuing to look for people to hire, if somebody loses their job because the economy is slowing in one place, chances are they're going to be able to find a job in another location in order to keep the economy moving along. So one of the key things that we'll want to watch as we go through 2024 is that, do we start to see a slowdown in hiring, and do we start to see a rise in the unemployment rate? If we don't see those factors start to manifest themselves, yes, it's a coincident indicator, which typically means that it's happening around the same time that the economy is slowing. But if we don't see those things happening, that suggests that the economy is likely to continue to move along. Another factor that is critically important, and it was a big driver of slowing economic activity as we were going through 2022 and heading into 2023, is inflation. The massive rise in inflation, the first major outbreak of inflation that we've seen in this country going back 40 years to the early 1980s. That had an effect on economic activity because basically if consumers have to spend more for the products that they're buying, and companies have to spend more for the raw materials that they're using in order to make the products that people are buying, that means that consumers are buying less and companies aren't making as much money. So we saw those forces peak out in the middle of 2022. The headline inflation rate peaked in July of 2022, and the core inflation rate, which excludes energy and food, peaked out in September of 2022. They have been gradually declining ever since. Inflation pressures have been fading back, falling back to more normal levels historically. This is a critically important element, risk number 2 to watch as we make our way through 2024. Does inflation continue to come down? At a minimum, does inflation continue to stabilize? If it does, that's positive. That's a tailwind for the US economy to be able to continue growing. Why? Because consumers get greater flexibility in order to maintain their purchases, and companies can increase their profit margins, so the money that they're making on the products that they are producing and the services that they're providing. So that's another key element to watch. Does inflation continue to come down? That has been the trend, and we'll talk about some of the risks associated with this as we go on later in our presentation. Okay, so the labor market remains tight. Inflation continues to come down as we go into the year. Another important factor has to do with corporate profitability. Are corporations making money? And what type of profits are they generating? Because if corporations are generating profits, then they have earnings that they can retain in order to invest in new projects, capital investment, capital expenditures, fixed investment, in order to continue to grow their businesses and grow the overall economy. And one of the things that we see with the current forecast for corporate earnings on the S&P 500 companies, which are talking about more than 85% of the companies in the United States, corporate earnings are expected to rise as we go throughout 2024. So companies are expected to make more money, more profits as we go through 2024. That's also supportive of the economy. So we have these positive tailwinds for the economy as we go into 2024. But I talked about how we entered into 2023 and there was all this skepticism that never materialized. Well, it's important to remember is that as we were going into 2023, there was a consensus view. Not everybody felt this way, but there was a lot of concern among economic and market prognosticators that we were going to see a slowing economy and a challenged market environment, and that never materialized. So as we go into 2024 and we're talking about all of these tailwinds that we see in front of us, it's also important to keep in mind that these are forecasts and things can play out differently than expected. One of the things we saw the first trading day of 2024, we saw the Purchasing Managers Index for manufacturing. Basically, it's a read on manufacturing activity in the United States. Came in much lower than expected with a reading of 47, which is below 50, which is a sign of a slowing economy. One of the things that we should be prepared for in 2024 is that the economy, although it's continuing to hold strong, there's a lot of factors that are coming together that are likely to slow the economy as we go into 2024. So these corporate earnings forecasts that we see that look so strong, they may not be as strong as they're forecasted right now. Being prepared for the potential for downside risk. Another risk factor that we want to watch for as we go through 2024 is that inflation reading. I mentioned unemployment. It's a coincident indicator we keep an eye on. And if it starts to rise, then we're going to get, it's signaling a potential economic slowdown is taking place. Inflation is the more important reading to watch as we go through 2024. If inflation continues to come down, or if inflation at least levels out where it is right now, critically important. Why is it important? Because so much of what drives not just the economy, but more importantly, because this is a market, economic and market outlook call, and we're talking about you and your investments. What's more important is the liquidity and the flexibility around liquidity that exists in the marketplace. The Federal Reserve has raised interest rates from near 0% that they were locked in for nearly a decade outside, or more than a decade outside of a brief period in 2018. They have raised interest rates up to 5.5%. So they have a lot of flexibility now in terms of lowering interest rates in order to support the economy if the economy starts to slow. But if we see a renewed rise in inflationary pressures, then all of that monetary policy flexibility goes out the window. Same thing on the fiscal policy side. Why did the U.S. economy hold up so much better than was being forecasted going into 2023? Well, one element, which is kind of an ironic twist, is we had that banking crisis that took place last March, which led to all kinds of monetary and fiscal policy liquidity being injected into the economy, which boosted the markets through the summer and kind of got things going to the upside through the remainder of the year. But it was also because there was a lot of fiscal policy spending by the U.S. government, by state governments, by local governments. A lot of that was going into infrastructure and infrastructure projects that were signed into law a few years ago. There was a lot of transfer payments as well. There was a lot of fiscal policy that was feeding into the economy, providing liquidity. So I keep using this word liquidity. Liquidity is basically that money, the greasing of the economic and market wheels. One of the things that helps support the fantastic stock market gains that we have seen since the financial crisis going all the way back to 2009 is that there has been an abundance and excess of monetary and fiscal, it's really been monetary, mostly monetary policy liquidity. If there's money coming into the marketplace on any given trading day or any given trading month or year, that is going to provide a boost to risk asset prices. As long as inflation continues to come down, there maintains that flexibility for liquidity to come into the markets, which is critically important. If we see inflation rise, that's going to constrain that liquidity. And that's going to be a key element, another key element to watch as we go through 2024. Liquidity, more than anything else, is a primary determinant not only of stock market returns and bond market returns. If the liquidity environment remains supportive, i.e. lower interest rates or lower inflation rates, then that should help support stock prices and bond prices as we go through 2024. All right. So in terms of the actual outlook, let's start with the stock market and the S&P 500 because we need to break it down here. So basically, here is a chart of the S&P 500, the headline benchmark index for the U.S. stock market going all the way back to early 2021. Basically, you can see the bear market in that red and black jagged line is the key line to look at. That is the S&P 500 on any given day. You can see the bear market in 2022, and then you can see the strong recovery, the strong bounce from those October 2022 lows that we've seen going all the way through 2023. Now, we extend this chart through the first half of 2024 to try to give a sense of where we could reasonably expect the stock market to go over the next 6 months, all else held equal. And when we say all else held equal, we hold out the possibility that there could be some unexpected events that take place that we're not necessarily aren't on the radar screen as we sit here on January 2nd, 2024. So one of the things that we see is that the market is in what's known as an uptrend, a sustained uptrend. And you can see that with the bottom of the uptrend being that green line and the top of the uptrend being the red line in that channel going all the way back to October 2022. The first important point to mention as we enter 2024, yes, there is a positive market outlook for stocks as we go into 2024. And yes, it's supported by strong corporate earnings, expanding corporate profit margins thanks to an inflation rate that continues to come down, and a job market that remains strong. But the market has come a long way since the end of October. It seems like a while ago now, but it was only a little more than 2 months ago that the stock market was having a tough stretch from August to October and fell a good amount, basically above the red line back at the end of August, at the end of July, excuse me, to the bottom of all the way down to that green line by the end of October. It was a fantastic bounce that drove us through to the end of the year. But we are now at the high end of this trading channel that bounces back and forth, going all the way back to the October 2022 lows. We should not be surprised. Let's give it a week or two because it's still Santa Claus rally period right now. And, and it'll likely even continue into next week. We should not be surprised if we see a stock market pullback, as we go through the end of January into February, maybe even early March. It can be a little bit disconcerting, just like it was during that period from August through October to see the stock market falling, but it's actually a healthy thing. It's a market that's pulling back, working off some of the excesses, shaking out some of the weak hands, setting a stronger foundation for that next move to the upside. So we shouldn't be surprised to see that pullback. What we can reasonably expect, given the fundamentals supporting the market right now, is an S&P 500 that could be trading anywhere between about 4,750 and around 5,200 by the middle of this year if this uptrend continues. So don't be surprised to see some pullbacks along the way in the headline index, but the underlying trend remains to the upside, at least as we sit here on January 2nd, 2024. Okay, what about the composition of this upside? Where is it going to come from? Because one of the things, a name that we started to hear around summertime of 2023 and has really become, thrown around a lot is the Magnificent Seven. What was the force that drove the stock market to do so well as measured by the S&P 500 throughout 2023? It was a very small group of big stocks known as the Magnificent Seven. So, I'll list what the Magnificent Seven are: Apple, Microsoft, Amazon, Alphabet, which is Google, Meta Platforms, which is Facebook, Tesla, and NVIDIA. Those 7 stocks accounted for more than 85% of the upside in the S&P 500 in 2023. A very small group of stocks that did tremendously well, and they drug the rest of the stock market along with them. Okay, why is that important? Because these 7 names are so big, and if any of these names start to falter, and it's been a tough day to start off the year in 2024 for some of these big names, if these names start to falter, it's going to make the S&P 500 look like it's not performing that well. And it's the type of thing that could drive the S&P 500 to fall back. But let's take a look at the other 1,493 stocks that make up the S&P 1500 Super Composite Index, and that includes the 493, and it's actually 496 because there's 503 stocks in the S&P 500. Go figure. But let's take a look at the rest of those stocks, because if there was 7 stocks that accounted for 85% of the stock market return in 2023, that means there's 493 stocks in the S&P 500 that maybe didn't perform as well and present an opportunity for investors as we go into 2024. And that's one of the key themes as we go into 2024 is the opportunity for a broadening of market performance. Just like it was true in 2022. If you were an investor in 2022 in the S&P 500, it was a rough year. But if you were an investor in 2022, working with your advisors, and putting together a strategy that was more aligned with your goals and more fine-tuned, and say you were allocated to energy or healthcare or consumer staples in 2022, it was a lot better year than what the S&P 500 implied. And that's the type of setup that we have here going into 2024. Is a market that, maybe the headline index sees some volatility because you've had these huge names that have done so well and are frankly have gotten, their valuations have become more at the high side of their range. There's a lot of stocks underneath the surface of the market that are set up to do very well. Stocks in the S&P 500 outside of those 7 names that are trading at their cheapest valuations since 2018, more than 5 years ago. And then mid-cap and small-cap stocks trading at their most discounted valuations going all the way back to the early 1990s. It's over 30 years. So there's a lot of discounts that are available in the stock market as we go into 2024. So even if we see some more volatility, even if it's a situation where the economy starts to slow, even if it's a situation where corporate earnings start to disappoint, even if it's a situation where inflation turns around and starts to be worse than expected, starts to rise, there's a lot of stocks, a lot of areas within the market that could continue to do well. And how would we define those stocks that are best positioned in a market like this? Stocks that exhibit quality characteristics, which is profitability and financial health. Stocks that have low price volatility. Stocks that pay a higher and growing dividend yield. And stocks that trade at a relative value. And those are the types of stocks, as we continue into 2024, that we're focusing on in terms of our investment strategy, in terms of participating if the market continues to rise, but also working to minimize and reduce downside risk if the market falters along the way. So that's your stock market backdrop. Now, it's also worthwhile to talk about areas outside of the stock market. Stock market gets all the attention. You turn on the financial news networks and, stocks all the time. And, oh, yeah, there's bonds. Oh, yeah, there's gold. But stocks. The bond market is a big area to talk about as well. And it's a big area to talk about as well from a total return opportunity standpoint. Yes, the yields are attractive in the bond market for the first time in a long time. Like, yes, you can go to the bank and actually get something more than 0.0 nothing % on your savings account interest rate and get a CD that's actually going to give you some interest over 12 months, 18 months, 2 years. But that also implies a lot of potential upside opportunity in the broader bond market that had not only had a tough 2022, but also had a tough 2023. The reason the bond market, primary determinant of bond market returns, is inflation. You get a high inflation outbreak, it's going to make a tough environment for bonds. Didn't provide that diversification benefit to stock investors the way that they had become accustomed to for so long. As long as inflation pressures continue to come down, that is a big tailwind for the bond market. So let's take a look here at what we're seeing in the bond market. Chart that we have before us has the chart of the 10-year Treasury yield. And a key concept to remember associated with bonds, as yields fall, bond prices are rising. So a bond investor loves to see the 10-year Treasury yield fall. A bond investor may see opportunity with a 10-year Treasury yield that's rising, just like they see an opportunity with the stock market that's falling. But a 10-year Treasury yield that rises means that bond prices are falling. So we got back to the middle of October and we had a unique setup here in the bond market. We had a 10-year Treasury yield that was working to try to break above 5%. And it was 0.75 percentage point higher than where it was in October of 2022 when inflation peaked. Inflation is the primary determinant of bond market returns. Inflation had been falling for more than a year through October 2022, yet bond prices fell fairly significantly, particularly during that period from April to October of 2023. This is the type of backdrop that provides opportunity for investors, and an opportunity it has been so far for bond investors since the middle of October. About 4 or 5 trading days, the 10-year Treasury yield tried to get across that 5% mark. It couldn't. And since then, the 10-year Treasury yield has fallen from 5% all the way back down to below 3.8% in recent trading days. I'll put that differently. That's a huge upside return in treasuries. People think treasuries, they think bonds, they think boring, they think, not much price movement. That's a double-digit return in the treasury market over the last 2 months because yields got so extended to the upside. As yields continue to come down, that implies continued positive total return for the bond market. And if inflation continues to come down, that implies a lot of room for bond yields to continue to come down and a continued solid recovery in a bond market that has had a really tough 2022 and a really tough, fairly challenging 2023. Last 2 months really kind of helped make up for that a little bit. But it was still a challenging 2023. It's a positive backdrop for the bond market in 2024. And I might even go so far to contend that the outlook for bonds is even more favorable from a total return perspective than the outlook for stocks as we go through 2024. It will remain to be seen, but it could be a pretty good competition between the two as we go through 2024. As we close out this economic and market outlook session here for 2024, I want to talk about the risks. A phrase that I was using earlier on, all else held equal. Taking out the fact that there could be some unexpected events that take place in 2024 that could change the outlook. Let's start on the stock side. The primary downside, and actually this is also true for the bond side. We're going to do a double here, both for stocks and for bonds. The primary downside risk, both for the stock market and the bond market, I mentioned it before, but I'm going to reemphasize it. I'm going to repeat it for emphasis. A renewed rise in inflation. There's a lot of stimulus out there in 2023. As we go into 2024, if we get a renewed rise in inflationary pressures, that is going to put a lot of pressure both on the stock market and the bond market. So that's one of the biggest things to watch as we go through 2024 is, do we start to see inflation pressures rise in any kind of sustained way? Because it takes away the flexibility for policymakers to provide liquidity to support the markets. So that's the number one downside risk. Number two downside risk, this has to do with stocks specifically. We are likely to see a slowing of economic activity. You'll hear that debate. Are we going to have a soft landing? Are we going to have no landing? Are we going to have a hard landing? What's going to happen with the U.S. economy? Whether we enter into an economic recession in 2024 or not remains to be seen. The base case in terms of this chief market strategist view is that if we see recession, it's likely to be mild at best, and the market is likely to look through that recession in terms of opportunity. With that being said, we could see a recession that's deeper than is currently being forecasted in 2024. Just like in 2023, we saw an economy that did a heck of a lot better than was being forecasted. If we do see the onset of an economic recession, particularly if it's accompanied with higher inflation, that could make for a much more challenging environment for stocks. So that's another thing to watch for, is how is the economy holding up and how are corporate earnings holding up in that economic backdrop? Again, base case here is that we continue to see an economy that grows, and if it is recession, it's likely to be a mild recession at best, but we have to take into account something other than what we might expect. It's a downside risk for the stock market, but that's an upside risk for the bond market. If we get inflation that continues to come down and the onset of an economic slowdown or outright recession, that is a tailwind for the bond market. The bond market loves economic recessions, assuming we have no inflation, and assuming it's not the 1970s. The bond market loves economic recession. Why? Because the Federal Reserve starts cutting interest rates at the same time that investors are looking for safety, the relative safety of bonds in general and U.S. Treasuries in particular. So what is a downside risk for the stock market is an upside risk for the bond market, the Treasury market in particular, and that's where you get that diversification benefit of owning both. And that's what we've seen for so many years, is that when stocks would fall, bonds would pick up the slack. It was true during the financial crisis. It was true during the bursting of the tech bubble. It was true during the 2010s when we had the European debt crisis and other factors that took place along the way. As long as inflation continues to come down, particularly with Treasury yields as high as they are now, that would provide a tailwind for the bond market. All right, the last element that I'll talk about, the last downside risk, because I know up on time and I want to be sensitive to everybody's time. One of the things that we'll hear a lot about, dysfunction in Washington, the uncertainty about the presidential election and the congressional elections, the threat of a geopolitical event taking place in some part of the world, war, things like that. Those can be shock events for the markets, where you get a short-term pullback, 3, 5, 7% over the course of 3, 4, 5, 6 days. Those tend to be situations that the market has historically demonstrated their ability to work through. So we may see a short-term shock associated with those geopolitical or political events that take place in 2024. Investors, barring some associated events that we would need to talk about it that have an economic or liquidity effect. If we have those types of geopolitical effects, more often than not, they present buying opportunities, not reasons to sell. And those are things that if they do take place over 2024, we will be talking about from a Great Value Advisor Group perspective with your advisors to get the messaging out around how to understand what might be taking place at any given point in time. So I'd like to thank you for joining me for this 2024 Economic and Market Outlook. It's been a great 2023, and I look forward to working together with you and investing with you as we go through the 2024 calendar year. Thanks, and I look forward to seeing you again in the coming year.